Good evening, everyone. This is Pankaj Kumar Rathi. I'm partner with Almus Consulting. At Almus, we look to be your partner in financial risk management, managing risk for currencies, commodities, as well as interest rates. Over the last 12 years of journey of Almus, we are grateful to serve more than 400 companies across industries. At Almus, we aim to bring for you the benefits of extensive research and aggregate knowledge from various sources. Monthly Webisode is one of such commitment. Monthly Webisode series is our way of spreading the knowledge with you all and in the process empower all of you in your decision making. However, what makes this possible is your interest and your participation. So I sincerely thank you all for your presence. Welcome all of you to season 2, episode 3 of Monthly Webisode series by Almus. At Almus, we believe that we are blessed with a network of friends and associates who are expert in their fields and do not shy away from extending their support time in our endeavors. I'm deeply grateful to all of the past and present current speakers. Having said that, let me welcome today's expert speakers, Sandeep Yadav, who is currently heading fixed income investments of DSP Mutual Fund and is responsible for managing approx 50,000 crores. Prior to DSP, he was group president with Yes Bank and was managing primary dealership business and fixed income for the bank. He has served more than 15 years with Yes Bank. Sandeep actually demonstrated history of top performance in macro trading. He has set up Treasury desk, primary dealership, and fixed income and derivative structuring. His skill sets include trading, financial modeling, fixed income, derivatives, and financial programming. By qualification, a finance professional, graduated from Indian Institute of Management, Bangalore, and a CFA. But by passion, a consistent learner, having even earned certificate or machine learning of certification of machine learning from Stanford University. The another speaker is Praveen Visesh, usually known as PV in Indian financial market. PV is currently a portfolio manager with a hedge fund and has spent more than 20 years on investing and trading Asian financial market. He has worked with banks like Chase, Citi, Deutsche, and hedge fund managers such as Modular, Millennium, and now currently with Exodus. But this does not sum up the character Praveen is. He is also a passionate fellow setting up a whole CBSE affiliated school in Madurai, empowering thousands of students as a life trustee. By qualification, he has completed master degrees from Cornell School and completed MSc in mathematics, along in addition to BE from Bets Pilani. Now that we know about our experts, let me set the background for the session and then hand it over to them for a deep dive. India has been consistently a twin deficit nation for years, and India actually have a disproportionately high fiscal deficit, not recently, but in the past, among other emerging markets, and that is primarily one of the reasons for lower credit rating, despite of a highest growth potential and leading contributor to world growth. In the last 2 decades, India has been the news as the next economic superpower or next China several times. But why not, since India has been only large economy with such an increasing GDP without inflation out of control very recently. The last 2-3 years, we have been able to control our inflation much better than the developed markets. Lately, all of us reading a lot about Goldilocks scenario in India. Even earlier, we have a mixed back set of instances. I remember in 2008 to 2014-15, we have been tagged as an emerging star as a BRICS nation, and then we shifted back to being a part of Fragile 5 in 2013-2014. India had been tendency of a higher inflation in times of higher growth. Do we have anything different this time? Yes, we have a strong demographic dividend. Also have been hearing a lot on the infra-based capex expenditure and development. But does number reflect this major change in relative terms? What are the macros for India? What is the leading to this favorite preference for investment by the FPIs? What are the inflation scenario, employment scenario, and what would be the perspective for Indian market? Not just that, we also look to see what are those things which can be harbinger for this expected growth. Also, I'm very sure that the people who are sharing screen with me right now, they will provide us with a valuable insights as do these exercise they do on a regular basis while taking decision in financial market. Just to set the flow, Sandeep, I will request you to start with your insights on Indian debt market, Following that, Praveen, I would like you to share the framework for decoding the Indian markets, what FPIs look like, and what is your current take for India. We shall also discuss Indian rupee and Indian rates, and how do we navigate these in a current dynamic times. Lastly, if both of you can also add your inputs on the global outlook. Later, then, we have a free-flowing conversation. You can all place your question at any point of time in the chat box. I will pick them up and will speak to the will place to the speaker for their thought process. Over to you, Sandeep.
Thank you so much, Pankaj. Thank you so much for such a flattering introduction. Uh, so you asked a lot of questions when you just introduced what we'll be covering in the webinar. I think a large part of the questions I'll leave it when you ask in the Q&A. What I'll start with is typically the framework and how we look at our country right now. It may not cover all the questions that you mentioned right now, but hopefully I will be able to show it probably when the Q&A comes. So what I'll do is I'll just share a presentation which I made, a small presentation which I made. And is it visible, Pankaj?
Yeah.
So these are the four small topics, and I'll probably take around 10-15 minutes for this presentation, not more than that. So these are the four topics that I'll be discussing. I think the first thing is about Indian macros, and you asked, how are the macros right now. Now, first thing first, the way I see in India, the macros are neither here nor there. We are actually we are not really booming very fast, nor are we crashing down, and nor are we seeing risks of crashing like we see in the developed economies. So this is one of the favorite charts that I like to show. And the right hand chart is probably my favorite chart. Now, why do I like is it my favorite chart? Because I like to show why inflation really does not matter in India when you're trying to make a view on the rates, or even if you're trying to make a view on let's say to a large part even currency. And I'll tell you why. The green line is the inflation projection that RBI publishes from the professional economists in the last for the last 6 years. The black line is where inflation has turned out. As you can see, most of the economists, like most of the fund managers, also try to benchmark and keep the 1 year ahead inflation expectation between 4.5% to 5.5%. No one takes a risk. But inflation, the error in the projection of inflation is 100 basis point. What it means is that in India, you cannot really project inflation. Projecting inflation 1 year down the line is like projecting tomato prices, onion prices, and that's nigh impossible, which even RBI DG Viral Acharya agreed in 2017. And because inflation in itself is not predictable, it has no correlation with the 10-year yields. If you see inflation was rising, yields were coming down. Inflation, when it was coming up, so was inflation coming up. And there's hardly any correlation between inflation and yield, even if we take away the COVID times, which were unpredictable in itself. What I would like to say is that when inflation really undershoots, that is a time when yields fall lower in India. When inflation really overshoots and we don't have the past data, that is a time when yields actually track inflation. But real undershooting or overshooting of inflation is impossible to predict in a country like India. And the left-hand chart shows RBI's projection and probably the seasonality projection. Inflation is going to be between 4.5% to 5.5%. And that, unfortunately, is exactly the way people have predicted for the last 10 years. And so inflation, while it's neither high nor low, but we don't know how it will come up 1 year, 2 years down the line. All it matters is you can't make your investment decision based on that you can predict inflation. Similarly, on the growth fund, this is the chart which I like to show, which shows that if you see India's PMI index is it's not really falling down as we have seen in some of the countries. We are well above 50. So India's growth is also very robust. When does growth impact rates? Well, it impacts rates when it really crashes down, which we don't see it happening. So even on the growth front, we are not really worried. We are somewhere neither here nor there kind of thing. It's not that we are running at 8.5% growth, nor do we see any risk of growth moderating. So that is where the macro, and I don't want to come look at other factors in macro. Probably inflation and growth are defining where we are right now. Of course, we can later on discuss, when you mentioned when India's growth is very high, India's inflation has historically been high. Probably we are in a different regime right now. We have seen a lot of supply chain changes happening. We are seeing fiscal deficit being prudent. And so probably we are not in that regime anymore, is my sense. But having said that, it's just a sense. It's, as I said earlier, which I again repeat, inflation very difficult to predict. The second thing is, if inflation doesn't matter, then what matters? And this we have seen historically. If you look at rate cuts, so I don't have a chart on rate hikes because rate hikes are not very relevant right now. But historically, whenever RBI has hiked the rates, RBI has hiked the rates when we have seen when there's been a strong depreciation of currency, be it 2013, 2018. The rate hikes were done when currency was depreciating. Even in 2021, post-COVID, the rate hikes were, sorry, 2022 it was, when rate hikes were done. They were not done because inflation went above 6%. The timing of the rate hikes happened when dollar rupee spiked up to 78, 79, and RBI had to now control dollar rupee by hiking the rates rather than using the reserves. So these are the three things. I mean, one of the hygiene factor is for the currency for RBI's rate cut is if CPI is not above 6%, which we are not right now. Fed action, if Fed is not hawkish, then RBI cuts the rate, and thirdly, rupee is not spiking up. So we see 2 out of 3 conditions met. The third condition is when Fed is probably in a more benign and a cutting rate cycle. We are awaiting the Fed to do that. Probably we are seeing Governor Das's comments also echoing what Governor Powell is doing. So we will see probably a rate cut in India, not because inflation is coming down, but probably because US Fed is cutting down the risk, because the risk of Fed action percolating to rupees real is very real. And this is a final chart. I really like showing it. So the blue lines are when RBI has acted in the last 10 years, be it rate cut or rate hikes. The red line is if Fed has also acted 1 month prior or 1 month later than RBI. So, RBI either had a sense of Fed action or there was a Fed action which had just happened and RBI had to react to it. This is pre-Governor Das times. Nearly 2 out of 16 times when RBI acted, Fed had not acted. This is during Governor Das's time. 10 out of 13 times Governor Das's actions are in a way echoing Fed action. And that is why, it just reinforces the argument which I just mentioned. The third part is currency. A view on currency. Well, we are positive on capital account, current account, equity flows are coming, bond infusion flows are coming, oil is quite stable, so that puts lesser stress on the current account. In any other country or any other regime, we would have said that currency will appreciate, dollar rupee will come lower. Not right now, because RBI is in a way ensuring that currency has a slow depreciation, probably similar to the range of interest rate differential that we have. And this is how we like to see. So while India's trade deficit had widened in April, this was made last month. We have seen it us showing current account surplus. Dollar rupee has been in a way somewhere in the flattish range. It has not really depreciated as much as other currencies have. I really like to show this chart. This is IMF reserve adequacy metrics. Just like banks have reserve adequacy metric, India is really in a sweet spot. It's really not in a very bad spot like Philippines, Russia. Usually India is above one. Sorry, it's not in a bad spot like probably Sri Lanka and Pakistan and even other emerging economic countries. And this is an IMF metric. They look at 7 different inputs before they drive it. Of course, Russia is very good. So that's why I was surprised when I said Philippines or Russia, because they're in a much more decent spot. And so is India. India is in a pretty decent spot. Most of the emerging markets have got worse IMF metrics. Similarly, external debt in India, very limited compared to other countries, and somewhere it shows in a RER. So RER is when you compare your currency depreciation with your currency valuation vis-a-vis other currencies, and we are again in the middle of the pack. You can choose any kind of RER. There are 3 different kind of RERs in India, but whichever way you see, it doesn't seem that Indian currency is really very expensive, and that is why while the capital flows and current account flows, in fact, it was current account surplus last quarter. I don't think it's going to be this quarter, but the higher BOP should mean that dollar rupee should move lower. But the RBI regime is such where they're micromanaging and they're ensuring there's no volatility and slow depreciation. So I think dollar rupee will depreciate. Just for the listeners over here, it's easier for RBI to let dollar rupee depreciate. That means dollar rupee go higher, then control, than stop the rise of dollar rupee. RBI can always stop the fall of dollar rupee. Why? Because it can buy as many dollars as it wants to. It pushes in liquidity in the system, but it can suck out the liquidity. But when dollar rupee is rising, it's very difficult for RBI to control because it's got limited FX reserves. Which are not in. I won't go too much into deep. Now, finally, I will come to the debt. I'll just finish last 5 minutes, probably less than 5 minutes, just talking about Indian debt right now. Indian debt, as I said in the starting, is not driven right now by inflation. It usually is not. Most of the time, it is not. Long-term debt is not even driven so much by RBI action. So we saw when RBI was cutting the rates, your 10-year versus RBI repo, overnight rate went nearly 300 basis point. Today it's 50 basis point. What it means when RBI hikes or cuts a rate, your 10-year bond need not necessarily follow that regime. Why? This is what drives demand, supply in Indian bonds is what drives. So this is our assumption, by the way. These are not published numbers, but usually we have been quite bang on for the last 3 years in our calculations. So Government of India comes up with GSEC issuances, and it comes up with SDL. States come with state loan issuances. And then you have got banks which will buy because of regulatory reasons, plus traders positioning. Insurances are growing in India by 12% per annum. PF is growing by 15% per annum. We have got FPIs coming 2.5 lakh crores thanks to the JP Morgan bond index inclusion. And if you look at the whole scenario, India's demand for bond is increasing by and large 10% per annum thanks to the regulatory requirement. India's GSEC supply has come down by 1 lakh, which is nearly 6-7%. India's GSEC supply has come down this year. Demand has increased by 12%. GSEC supply is down by 6. Probably SDL supply will just increase by 5-6%. There is not enough bonds to buy, and we will see through the year that bond yields will not rise up, and there'll be a lot of pressure for bond yields to come down. We have already seen it for the first 6 months. People say that FIs have already bought $10 billion, but frankly speaking, FIs have bought $10 billion because banks have sold a significant amount, and the regulatory requirement of SLR is already low. They will have to push it back in sooner or later, and when they increase the SLR requirement, bond yields will again fall down. I don't know when the timing will come because it's very difficult to time it, but we are very clear that yields are coming lower. In fact, this slide just, I will not go into nitty-gritties of this slide, but this slide just shows, how demand supply was very evenly matched in FY24. And in FY25, we see demand supply. There's just not enough bonds in the market. Now, why does it matter? Because we believe RBI is going to sell bonds this year. And because RBI is going to sell bonds, there might be a little bit of sell-off because RBI has to provide those bonds in the market. There'll be a little bit of uptick in yields. I don't think investors should get worried when that happens because it's very difficult to time. But the fact is, despite that, yields will trend over. And finally, what I'd like to show is we can clearly see this happening. US yields, while we were tracking US yields quite closely, last 1 month, US yields have not fallen so much. Last 2 months, Indian yields have fallen quite a lot. And this trend is going to continue, that when Indian yields have more gravity than US yields. And I think finally, and I close my presentation, and hopefully I've not taken too much time, Pankaj. And I close my presentation by saying, so one of the arguments that we get with many people is that Indian 10-year bond is just 50 basis point higher than repo. How low can it go? Well, historically, if you see, this is just before the rate cuts, the spreads have crashed down significantly. The only reason why people are saying that it's low is because during COVID times, as I mentioned, it was quite high, 200, 300 basis point high. And there's a recency bias over there. If you take away the COVID times, it was unnatural. The spreads have really come down. In fact, when I talk about this, if you look at countries like US, you've got 10 year is more than 100 basis point lower than their overnight rate. So when we are 50 basis point higher, I don't think we are anyways, the term premium is low right now. I would not go into a surprise index, and probably this is the way when I put everything into and it's a very simplistic, this thing, don't take it as a proper macro eco way. This is a very simplistic way of showing. We see inflation a little bit lower, we see supply very low, we see demand very high for government bonds, we see FPI demand also being very over here. So there are 3-4 reasons why we see why bond yields could come down. Growth and currency will not have any impact according to us. Global yields very difficult to predict. Geopolitics difficult to predict. So 4 reasons why we see bond yields coming lower. I think one of the reasons why we see bond yields may move higher is because of the current RBI regime and the RBI OMO sales risk. But I think it is very contained and it will not be trend setting, but it will just create the noise. So in whole, currently, while we might have rallied 30-40 basis point in last 1.5 years, but I think it's just a start if you ask me. And there's, I wouldn't say it's just a start, but we are nowhere close to the rally being over, and there's a lot of legs left in this rally according to us. And that's it. Thank you so much.
Yeah, thank you, Sandeep, for taking out basically outlining the framework and then basically telling us that inflation doesn't matter, it's the demand and supply which is more important. So got you. I will have some questions. I will take it on later on. Uh, when I was discussing with PV, Praveen, about what he will be discussing, so he said that I will take a historical context of Indian market and Indian rupee, and then we'll try to outline his framework of trading Indian markets. Over to you, Praveen.
Okay, thank you, Pankaj. Good to see you. It's been a long time.
Yeah.
Thank you all. So very quickly, I mean, I've been trading the Indian market since 2001. And in my understanding, there are regime shifts which we need to be aware of and we need to track. While I really liked one thing which Sandeep said, that India's situation is neither here or there. And I broadly agree with him from my framework point of view, which is very price-led. So I look back in history, I look at historical setups, historical price setups, and connect the dots in different scenarios and markets. I'll give you some examples which could help you understand the way I look at it. We are all talking about how INR RBI is there on both sides, managing and monitoring the currency quite actively. And there are actually very few instances in the history of not only India, but other EM countries where there has been such low vol for such a long period of time. And given that this is the case with India and specifically INR and actually even on rates, according to me, it requires a lot deeper understanding of what is happening here. And for me, I think a large part of it is that this is a policy play by both the government and RBI. And it's only over a period of time we will understand what exactly the policy play is. I personally don't think that it is something to fight over, which is that, I don't think we should say that why is RBI doing this? It will eventually become clear. But what is better to understand is the consequence of such low vol regimes. What happens? In the recent history, we would all seen, for example, Mr. Raghuram Rajan coming in and, kind of bird caging INR to its forward rate and gradually shifting INR higher. Like that, if we go back in history, we can see how every change in government or central banker has actually led to behavioral patterns. In the current situation, I can tell you it is futile to expect INR to become super volatile again. And as part of my framework, I look at positioning, carry, and if any of it is an excess, then I prefer to take the other side. In the current situation, on both INR and rates, I don't think there is a very firm view or trade in it. But that doesn't mean that people should be lax or lazy about hedging. Hedgers, for example, should definitely be doubly sure and aware of what their position is, especially this low vol period. And we are seeing that happen in CCL volumes, which have really collapsed. All these have implications over a period of time. I do not recommend chasing rates at lower levels, especially behind the index flow. It is something which has been a very big point of discussion and analysis. The index flow is spread over a period of time. And being too heavily positioned after even this kind of rally in India is not something which I recommend. Currently, suggest to be very cautious on India and especially look for trigger factors, for example, oil, or even for that matter, DM rates kind of moving higher, is something which I'm very watchful for.
Thank you, PV. So, PV, first question to you. You are saying macros not here and there, and I'm sure that you would be tracking Indian equities market. Indian equity investors are thinking otherwise. What do you think about that? They are gung-ho, they are accumulating all the dips, but even I have not seen much of a dips also. So, what's your thought on this?
Well, I'm not a fundamental valuation guy, and I'm not here to give a very strong opinion on equities. I do trade Nifty and Bank Nifty very actively, and I can tell you during this period of active currency and rates management by the policymakers, I think equities long is a very good bet to have on, and I think Nifty and Bank Nifty can continue its path higher, irrespective of what valuations talk about. We've come at a time when FPIs have actually been good sellers of equities, domestics have been good buyers of equities, and I think that trend definitely continues. We would be fighting the trend by either lighting up or going short equities at these levels. So I mean, anybody long would continue to suggest that it's the right direction.
Sandeep, same question to you as well.
So, in fact, I was listening to Praveen's answer, and probably both the answers that he gave, I've got a divergent view, and that is because we are probably in very different markets. He's probably more into equities, and I'm completely into fixed income.
I'm as much fixed income, Sandeep.
So, I think I'll take your equity answer and I'll put
Sure.
it in fixed income, where I say that probably this is not the right time to fight against, what you say, spit against the wind, if I might use a term, because we actually took quite a long position about 1.5 years back, and we took it right after February 23 budget. And looking at the numbers that we saw at that time, of bond inclusion was nowhere in the picture, but fiscal prudence was quite clear, not just from the government of India, but also how they are ensuring that the states also bring all their off balance sheet into within the balance sheet, and then of course the state's fiscal is also quite under control, and they have completely stopped off balance sheet borrowing, be it central government or the state governments. When the JP Morgan bond index inclusion came, it was certainly a very good point because it just adds a couple of lakh crores of inflows. But having said that, we are quite clear that RBI will absorb a shock of it. I don't know when they do, whether 6 months down the line, 3 months down the line. They gave a primer in October 23 policy when they said that they'll come up with RBI right after 28th September, JP Morgan bond index inclusion was announced. So from that perspective, I think the bond inclusion has been really whipped for too long, and probably it's not that big a game changer, especially if RBI steps in, which we believe it will. But where we do think that demand supply is changing quite a lot in Indian bonds is evidenced by how 30-year bond and 5-year bond are today trading at the same yield. Now, why? Because 30-year bond is an asset-driven, it's a demand-driven, it's not a speculation-driven paper by and large. And the PFs and insurances, as I said, they're increasing at 13, 14, 15. NPS is increasing at 25% per annum. And despite government having brought their long bond supply to 40% of the total supply from, I think, 20 odd percent of the years back, they have stretched as much as they could, but still the supply is quite high. We, in fact, are completely into long bonds in the funds that we can. And when I say long bonds, 30 to 50 year, we remain invested. We have seen in the recent sell-off in the last 3-4 days also, we have seen those are the only papers which are giving capital appreciation. And I think I wouldn't be surprised if we go US way and we see a little bit of inversion in the curve also. So Pankaj, you mentioned demographical change in India and all, and we have seen demographical change, how it impacted the yield curve across the developed markets. So having said that, I think that's what makes a good market, right, Praveen? Probably oil shock will come and I might have to take stop loss, or probably the way things continue the way they do, and we end up seeing bond yields lower. But we are quite on the same zone. On the equity front, I think that it's overvalued like anything. But again, you don't spit against the wind. And if you're having 25,000-30,000 SIPs coming from domestic investors, and they're not willing to take the money out even on an election day when we saw a shock and we saw 10% erosion of the value, I think it's better to be long. I don't think Indian equity is going to suddenly one day turn around, because these kind of flows don't go immediately in one day. It takes few weeks and months to go. So even on that side, probably the demand supply is playing both in equities as well as debt.
So I'm continuing with the equity question again. So historically, we have seen, basically economically or theoretically, whatever we have read, it should be having an equity and bonds should be having a negative correlation. But that's not happening in last couple of years. Any thought on this? It's only the liquidity chasing the markets, or it's nothing related with fundamentals?
Praveen, I'll let
Sandeep.
you take it. Did I say it before you?
No worries. See, I mean, in a economy like India, that stock to bond correlation and equation of float just does not hold right. And more so the adoption of equity investments by retail plus SIP, all that is just quite pretty much in the nascent stage. So I do expect that to continue to grow. And broadly, I think India, it is an equity unlocking story over a period of time. I think FDI, FPI, China plus one, there are enough reasons. And I agree on the valuation, which is why foreigners have kind of liquidated or sold equity holdings over the past year. And more money has come into debt largely because of your passive requirement and a little bit of active participants coming in ahead of it, especially in a stable currency environment. The stable currency is by design. It is not natural. And here is where I think there are many different reasons to have uh, both rates and FX stable. I mean, I can just add a couple of points as to why I feel that it is by design, largely because we are now no longer part of RCEP, and we are having bilateral trade agreements with a lot of our partners, which is some of which is still in under formation. And in these times, I think a stable FX and rates regime helps the economy and the country from a broader perspective. So I think what RBI and government are doing is justified, and we'll know only the reason for it at a later date. But I think this is part of a much bigger plan, especially to make us self-sufficient and to allow internationalization of INR. It's a more broader picture that I think is getting answered here, especially coming in from 2013 when we had a currency crisis, at our door. I don't think cost is actually going to be a big factor for RBI to consider at all. I'm of the view that what they're doing is right, and we should not try to fight it. And in fact, India has one of the best diversification of sources of oil and energy. And as we continue to grow, it is very essential to keep our hedge rates, our hedge ratios, especially for our oil and all that, in balance. All this is linked. I don't think the equity to debt connection holds in a country like India, and which is why I feel that equity investments or equity investments in by retail, by domestics will continue to happen and continue to grow.
Sandeep.
So I do agree with Praveen literally what he has said, and I think when you said that historically macroeconomics, you say one asset class goes down, another goes up. Well, you generally have a fixed amount of pool of money, and people substitute from one pool to another. We saw this anyways break during the COVID times also, or whenever the Fed has increased its balance sheet, a lot of money going, and both the asset classes have rallied, right? And we have seen that happen in history. In India, we are not seeing that kind of explosion of reserve money. We are not seeing that kind of explosion in the balance sheet of RBI. But what we are seeing, on the other hand, is, as we mentioned, demography and the financial savings, how they're increasing so fast. And suddenly people are willing to put money. It's not that they're selling bonds and putting money over equities. And it's not that FPIs, if FPIs are selling equity and probably investing in bonds, we are seeing that getting offset because of the domestic change in the demography and the asset allocation pattern. And that's why we have seen historically, we have seen in the last 20 years in countries where both the asset classes are moved in tandem. And while it's not the exact reason, but probably it's quite parallel to that reason, where we see, in a way, financial assets increasing in the country. And that's why we are seeing this, and we probably will see for some time to come.
Thank you. Sandeep, you spoke about inversion of a yield curve in India. As of now, we are seeing I think most of the flattest yield curve. I have not seen this kind of a flat yield curve in last maybe 10, 12 years. What do you think? Which part of the yield curve now need to move lower, and whether public should be putting money there or should be putting at the longer end?
Good question. So, Pankaj, when I joined mutual fund industry around 3 years back, I came up with a note, yield to immaturity, because at that time the yield curve was very steep and a lot of people were investing in 5 year, 10 year, saying that they're getting a very good carry. But the fact is, the yield curve was steep for a reason, and the reason was when yields rise, and if you are buying 5 year paper, you'll end up making a lot of losses. We saw that happening. We came up with exactly the same headline 1 year back when Indian yield curve had flattened and it was completely flat. We said it's yield to immaturity if you're running after 1 year, but not running after longer tenor bonds. There's a reason the curve is flat. The reason is quite simple, that despite government coming up with the maximum borrowing in the longest tenor bonds, the demand over there is very high, and that demand is not going to become zero next year because your PF are going to increase by 12-13% every year. Insurance will. You can always say that mutual funds will not buy, or FPIs, active FPIs will not buy, or traders will not buy. But it's the demand from insurance, bank SLR, and PF is always very, very predictable. And so from that sense, we still like 30, 40, 50 year, which might sound a little bit extreme, but fair enough. We have run a very extreme fund, which has done decently well. And we see no reason why a fund will not do well going forward, because we just don't see in what scenario will your 30, 40, 50 year yield rise up. Yes, yield curve is flat. Actually, it's inverted. So if you see 10 years lesser than 4 year and 5 year, and yes, we expect the inversion to go on forward, going forward. And the best point of the curve for us is probably 30, 40, 50 year right now as well. We would not prefer to be in 10 year because that will end up being a little bit more volatile.
Understood. Both of you, I will ask one question. Basically, in US also it's going now. What is the neutral rate for US? The same question will, after some time, will again reach to Indian soar also. What should be the neutral rate for India? Because we are seeing kind of a 4.5%, 5% of inflation, 6.5 current rates. What should be our neutral rate?
I'll take this, Praveen, first. I'll help you out. And I'll take it first because I'll tell you bluntly, if I knew the neutral rate of US, probably Powell should be speaking to me. And I have no earthly idea what's the current neutral rate of India, or what was it 5 years back, 10 years hence. So this is beyond my scope of understanding, or even understanding probably, but knowing no way. Praveen, it's all yours.
And I have pretty much the same answer as you. I think it's a futile effort to try and gauge it. Any questions to RBI has always been deflected. And I don't think it's a relevant question from a policy perspective that we need to address right now. So sorry not to help you.
Praveen, you spoke about internationalization of rupee with the theme which we are basically hearing for last couple of years now, post-COVID and maybe post-Russia-Ukraine, de-dollarization of a dollar. So internationalization of rupee and yuan will take time. What is your thought on de-dollarization of a dollar, and whether India would be able to capture some of those de-dollarization benefit?
Yeah, I think we're already beneficiaries of that to some extent, with mobile phones being manufactured in India, and this whole China plus one theme picking up pace. I think we need to definitely shore up our reserves, protect our assets. We have the ability to pay the bills of our imports. I think a large part of what RBI and government are doing is towards ensuring this stability. From internationalization, I think it's going to be a more step-by-step process, right? I mean, the kind of agreements which they have with Singapore, which they have even recently opened up access for foreign countries to open up INR accounts and leave their money in INR. All these are good forward-looking steps, but there's a lot of time for it. Our NIIP, which is the net international investment position, is still less than $300 billion. I haven't seen the latest number, but that kind of tells us that we need to see continued pressure on building our reserves, ensuring that we protect ourselves.
Sandeep, would you like to share your thoughts on the internationalization of rupee or de-dollarization of dollar?
I, I, th- I think I'm a very big pessimist when it comes to these things. I believe it will be very difficult for India to be de-dollarize our capital account convertibility for last 20 years and seeing how India goes. And frankly speaking, probably Praveen is a bigger expert than me in this, so mine might be a subjective view. But we have seen a little bit of rewinding of the liberalization that happened during Rajan's time when it came to capital account convertibility, making it easy. I think last year itself we brought 20% tax, of course, which can be claimed back on the LRS increase from 5%. Somewhere when you're talking about in rupee becoming an international currency, I think two things are required. Firstly, you need to be more capital account convertible than where India is. Second thing is you need to run some capital account surplus also with the countries, because what's the point of them owning up currency but they are not buying anything? We're still buying more from them. Uh, I feel that these are headwinds until the time they get cleared up. It might take some time. On de-dollarization, again, I am a big believer that it's going to take long time for de-dollarization of dollar. We are probably running a little bit into the Cold War times then in the last 5-10 years we have seen. So probably we might see a little bit of block on the Russia, China, and as we see North Korea, and then we're talking about again some Middle Eastern countries, and then we're talking about the West. And what happens when you have these kind of blocks is a lot of trades, of course, is happening within each block, and because a lot of trades which are happening through global now is happening through Russia and China directly, or they have routed it through there, then obviously I think your dollar will lose a little bit of trade volumes, because suddenly you're trading within your ecosystem rather than globally. Is this what is happening to when we see dollar trades coming lower? Partly is generally dollar trade, which ballooned up after the after 2000, after Russia coming, and I think it happened in last 20 years how it ballooned up the dollar trades. Probably a little bit of rewinding of that, and probably a little bit of emergence of different blocks. So I don't think in my living time I'll see dollar not being the premier currency, but let's see. I mean, it's a very, very volatile world, very, very fluid world, and we don't know how things might turn out.
I agree. Probably will not see that, but definitely, as you said, the different blocks, bilateral trades, and that's happening. And as Praveen said, definitely we have got the benefits of that.
Yes.
Uh, what do you think about our upcoming budget? Whether that will change your bond market equation? Whether the RBI dividend will reduce the net supply to the market, or whether the government will increase some more borrowing for putting up a more infrastructure, because they need now to basically, after the election kind of election construct, they probably would be looking how to give benefits to at the lower end of the value chain or lower end of the population strata. What's your thinking on this?
Asking me,
Yeah, then
you know,
Praveen.
so I love the first line of Charles Dickens' book, right? It was the best of the times, it was the worst of the times. We always feel, something extreme is happening, but frankly speaking, I don't think it changes anything. I don't think budget is going to throw any surprises. Will government be more expansionary? It might be about 1 lakh crore, but then dividend has come by 1 lakh crore and net off. And governments don't become very expansionary in the first year after winning the elections, right? They become fourth or fifth year. As you're coming closer to the elections, you start coming with a much more expansionary budget. I do not see government doing that. Of course, they have increased MSP by a higher amount, which I think will give 15,000-16,000 extra. They might come up with more SOPs for Bihar and Telangana, sorry, and Andhra. But when government has already got 1 lakh crores of extra dividend from RBI since the February budget, more than 1 lakh crore than what was accounted for, it is more than enough to absorb it. Lastly, governments don't, at least Indian governments don't increase the borrowing at the starting of the financial year. If they feel that they're in a little bit of worry, they'll think about it in December. So I don't expect any surprises in the budget, and probably it's just going to be a boring, or rather, hopefully, it's just going to be a boring budget.
So, Praveen, question to you: when US and China are when basically increasing their fiscal support to the markets, do you think India will be forced to do at maybe some point of time, or the fiscal consolidation which India is thinking about in this kind of a time where US and China are adding to the fiscal support? Praveen, did you hear
Sorry.
me?
No, I had got disconnected. Apologies, I just came back.
No. So what I'm saying is basically in India, the fiscal consolidation kind of a thing is going on. We are continuously reducing our fiscal deficit number relatively. When US and China are adding support to the fiscal side in this where the markets are, do you think India will continue to consolidate its fiscals, or they might be under coming pressure to provide fiscal support again?
See, I'm not a fundamental macroeconomist, so I will leave that discussion to Sandeep or to someone else. I think who can do a better job. But in my view, I think the repercussions of we have seen the past 2013, the degrees of freedom with which we can operate, is something which I think RBI and the government are very well aware of. The risks, for example, of hoarding of tomatoes or onions and the price shoots like that, and followed by the global impact of something like an oil, etc., is very fresh in India's memory. And I think what they're doing in terms of building up reserves, in terms of fiscal consolidation, is definitely on the right path. For foreign investors, I can share that at the end of the day, a lot of these things, including ratings, including easy access, all these matter. We do go through a process through the investment committee which decides, is all this good to invest in? Is liquidity ample? So I would say that the path is right by what the government and RBI are doing, and they should continue to remain on this path. And we continue to engage with RBI and government wherever we can to share our perspectives.
But Praveen, in the current market scenario where India equities looks like valued rich and China has not been doing so well, do you think FPIs might think of switching off? They were doing in past, switching off from India to China, and because you trade most of the Asian markets, I would also like to see your perspective or look your perspective on a currency valuation in Asia pair, because we have seen lots of Asians have depreciated. Rupee has not depreciated to that extent. How do you perceive that, and how the flows look like currently?
See, again, I'm not a valuation guy, but what I can share is that the risks with China are still very much real, and which is what we are seeing happen in terms of price action on, for example, China rates. If you look at 5-year China swap, they've been on a pretty much one-way move lower over the last 6, 7, 8 months, and they continue to go lower every day. And while we've seen kind of a relief rally in Chinese equities, I think that's definitely could be short-lived. I don't see a significant sell-off, nor can I see a sustainable rally from here. It's largely because of the opaqueness with which things are being operated here, operated there. So I'm quite uncertain. Will hesitate in giving a very firm view on China. All I can say is I would probably stay away. And so that switch from China to India, I can tell you that whoever had to do it has already done it, and I wouldn't chase that trade.
Got you. So no chasing India against China at this point of time. Let's look for the better times ahead.
Absolutely right.
Your thought on relative valuations of all Asian currencies, which looks better at this point of time?
See, we're at a time where I trade all Asian currencies, and I can share that central banks are there everywhere in Asia, be it China, be it Thailand, with BOT sitting, slightly above where currently dollar Thai baht is. Bank of Korea holding 1400. It's and largely the reason why we're seeing vol and breakouts not working in the way traditionally they work out. FX has been quite a ranging asset class this year, and it's not given any, and even when breakouts have happened, it's not followed through. This is not a chasing year. Hedge funds normally thrive when markets break out and give that momentum. So it's not a chasing year at all in the FX world. So I would say it's very difficult to pinpoint, what is fair value and what is not. I can share that with the extent of reserve accumulation which is happening, and typically in India's case, historically RBI has built reserves when INR has been appreciating, and this is one of the times when INR has not appreciated. It's kept at pretty much its weakest level, and RBI and we do continue to build reserves. So to me, that's definitely a much larger policy play, and not to fight that.
Understood. If anybody has question, they can put up their questions in the chat box. We'll get it answered by Sandeep and Praveen. Praveen, do you think India rating will be changed or improved in next 6 months to 12 months by any rating agency? Because that will probably attract more flows towards India.
I mean, we definitely need a rating upgrade, and I think that's something which the government has been pushing quite hard on. But however, the main contention has been from all these guys that fiscally they need to see better numbers, and which is why I strongly believe that India is on the right path, irrespective of what the rating agencies do. We've seen historically they not being the right benchmark for how economies are and how countries are. So I think we're on the right path. Whether it's next 6 months, my personal view is no, but I could well be wrong.
Sandeep, India rating upgrade.
I will not hold my breath for it. The last time India was anyone changed India's rating was, I think, around 16-17 years back, if I'm not 2007 probably. After that, we have seen GFC crisis, we have seen 2013 fiasco, we have seen India doing very well, very bad. The ratings don't change so easily. So my sense is there's still a long way to go, long way. You cannot put a trade right now expecting a rating upgrade.
Got it. We have seen a continuous bull market for very long now. Do you think whenever the market fall abroad or globally, India will be decoupled, or India will also take a good amount of burnt of that, Sandeep?
Well, I think India will be able to absorb better. It might be coupling would be there. Probably the beta will be much lesser. We may not fall as much whenever that happens because domestic money is flowing in. This kind of money is probably more sticky.
Praveen, your thoughts?
So I have a slightly different take on that, because at the end of the day, I look at carry positioning, what the central bank has done, and I can tell you that market is heavily long INR. Like even the non-India traders all have a long INR against some other currency in their book, and it's quite clear that positioning is really heavy given what I track. Different sell side banks come out with positioning reports. And at the end of the day, RBI has accumulated reserves quite substantially, including the forward book. So for me, it depends on what the kind of crisis is. And while I do understand that RBI has much more than absolute number, the willingness to act, I think that itself is a very big deal. The willingness to act is very much there. But in this current time, when depending on what kind of crisis, I think RBI might be very surprised on the pace of drawdown of reserves, depending on the type of crisis. If it's an oil-led crisis, I mean, eventually it might just be a brief burst up, and then RBI will be able to control it. But that intensity with which people will buy back dollar rupee, I think we would all be very surprised. And I think the reserve drawdown number could well be above what we saw last time around when we saw the dip from 660 billion to below 550 billion. I think we will be very surprised that there's so much of demand in dollars, depending on the type of crisis. So I'm assuming real crisis could be an oil crisis, oil going up to 120 plus, in which case we would face this issue on INR.
So there is one question from Jairam K. Praveen, this is for you. What level of JPY is a global macro risk, like when central banks or other, then BOJ also acting concerned on its steep fall? What level would be a kind of a panicky level on dollar JPY?
You need to understand a bit of history for this, because if you look back, we've seen dollar yen above 200 coming all the way down to below 100. And since 2016, Japan got into YCC and controlled rates, and that led to a substantial reduction in JPY wall itself. In 2022, there was a significant burst in differentials, which is inflation differentials, interest rate differentials between Japan and US. And the currency actually lagged that move, which is why, it was between 110 and 115. And then we saw the quick catch up to 145 plus. I think in this current time, with the repricing happening in Japan rates, the excesses that we've seen in the past do come out in some form or the other. So this control of Japanese rates, this control of US rates for this longer period post GFC is what we're seeing now in terms of significantly higher inflation, sticky inflation. And so if you ask me, that level of dollar yen could be much higher than where we are today. And I do expect that at the end of the day, the interest rate differential is still very much there.
In favor of the dollar.
In favor of dollar. So every central bank that I track is all supporting and selling the dollar against their currencies to prevent significant depreciation. I think BOJ might continue to remain at it, but that level, it could be quite fluid. I would expect it to continue to test the limits of what is comfortable.
There's another question to you as well. What is the expected range of USD INR for current FY 24-25? What is the range you can expect in dollar rupee?
If you ask me very realistically, I would say 83.30, 83.60.
We will be out of the business, Praveen. Okay, your closing remark on the today's financial market, and then we will take closing remarks of Sandeep. We are almost reaching the time.
Okay, thank you. I would say that we are in exceptional times because we've not, in the history of rates, seen such high rate of change or repricing of interest rates globally. DM markets are no longer at the lower bound, and the volatility in DM rates is high, is unprecedented, and it requires us to be very watchful of what we think could be reasonable vol. All these have consequences in terms of asset prices, asset bubbles, in terms of commodities, as we see deglobalization continue and become stronger. And then, like Sandeep said, this Cold War, which is actually taking multiple shapes. I think we need to be very watchful on the impact of all this. I think China's slowdown has definitely helped in contain the entire commodities complex. But eventually I would watch out for commodities moving higher again. And globally, we need to be quite watchful on inflation. Cannot let go of that.
Would you also like to, the way you have said that the containment which Japanese BOJ has done for last couple of years, lower interest rates and YCC, and then controlling the dollar yen, the similar kind of a thing might happening in rupee currently, or maybe in Indian markets where even the yields and probably will be much contained after all these developments, where it will reflect later on. What is the
So every market continues to build till the pressure is unbearable in some form or the other. And for me, while INR is comfortable from all the metrics which Sandeep kind of highlighted for now. I think we, if you ask me in an Indian context, it's very difficult, and I would say that the risk is on inflation much more than anything else. That is, if you ask me to rank risks, I would say inflation in India is probably something which would be top of my worry. It may not be now, but at a later stage for all this wall controls, we need to be watchful on inflation.
Thank you. Got it. Sandeep.
No, I think for me the biggest risk is probably the complacency in the market, the way the market believes, and they're running with the view and the certainty of them believing that the view is going to be correct just because it's been correct for the last 6 months. So for me, it's a volatility and the risk cost scenario. If there's a global risk cost scenario, then I'm actually very worried about that. But having said that, I'm worried about black swans also, something which I don't know right now, but which may come up. So the way I look at it, I think last 1 year was you take risk and you don't worry about things going wrong. But right now, if you ask me, something that I really fret about is, will I be able to exit my position before those untoward events happen? And I think people need to be more cautious, look at data more closely, and be willing to act much earlier than usual, because probably there are risks lurking around every corner.
Yeah, got you. So black swan, volatility, and then inflation. Thank you. Thanks a lot, Sandeep and Praveen. And thank you all participants. I've thoroughly enjoyed it. I hope that you guys have also enjoyed it. Thank you for spending time. Best of luck for India, England. Probably we will win today.
Thank you so much.
Thank you.
Thank you, guys. Bye, Pankaj. Bye, Sandeep.
Bye. Thank you. Thanks a lot. Thanks for your time.